Stock markets marking time today despite a little bit more event risk, and it doesn't look like they're paying much attention. So what will it take to move things along, and what is it that the markets are so concerned about that they can't seem to build on yesterday's exuberance? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we'll do here is we'll take a look at what seems to be inspiring these markets here and how that is leading us into this sort of confused standstill, which we can readily see here on the S&P 500, and what will it take for these markets to start to be a little bit more convinced about what's going on. Obviously, we didn't have the world's greatest amount of economic event risk, but what we do see here is a little bit, at least, by way of the FOMC minutes for the May meeting that came out here. And as we discussed yesterday, the main sort of issue here, of course, was that the Fed seemed to come out in May with quite the defensive sort of language at the same time that we were already well into a recovery from April's crisis lows. And we can see here, just for reference, the Fed meeting was May 6th through the 7th. That's right here. By the time we're here, the market has already rallied close to 19% off this low and has erased more than half of this overall decline. So, needless to say, the markets are feeling pretty good right here, but the message from the Fed was decidedly more downbeat. We can see from the policy statement here, the story was that uncertainty about the outlook has increased further, that risks of higher unemployment and higher inflation have risen. So, even just in the policy statement, things are a little bit unnerving. And then, of course, Fed Chair Powell had his press conference, and he was quite feisty and really pointing a finger at trade policy and saying, this is a black box. We don't really know what to do here. We know that in the past, what has happened is tariffs have been bad for growth and something that is generally inflationary, but we don't know how this episode is going to work out, so we're going to sit on our hands. And when you look at the minutes that came out from that meeting, you get the sense that something very similar is on display, and I've highlighted a couple choice points here. So we can see here, there's that May meeting. As we saw in the statement, they agreed that policy is well positioned to wait for clarity, because very clearly here there is a risk that unemployment will be higher. There is a risk that inflation will be higher than anticipated. We see that here, and we get this sense then that the Fed is feeling like its hands are tied, and that it's not going to make changes. Now, what's especially interesting here as well is that we get the sense that inflation is expected to be more persistent than expected. Moreover, growth is expected to be weaker. We see here that the staff projections for 2025 and 2026 GDP as of May are actually weaker than what was estimated in March. And in March, we already had downgrades. We can kind of see what all of this looked like in the March summary of economic projections, where we see that growth has been revised lower for this year and next, inflation higher for this year and next, unemployment rate at least higher for this year and then steady thereafter. So what these minutes imply is that in May, the divergence got more aggressive. And we can see here, participants noted they may face difficult trade-offs if inflation proved more persistent while the outlooks for growth and employment weakened. Now, this is not a happy mix, but the markets clearly opted not to panic in any kind of a discernible way. We're a little bit softer here after yesterday's jump, and perhaps that's somewhat telling, at least, of just how much follow-through there was to be expected on yesterday's jump. That, of course, follows news that after Friday's teasing of a 50% tariff on the European Union coming out of the White House and the walking back of said teasing over the weekend, after apparently a happy call between President Trump and Ursula von der Leyen of the European Union, we end up with a healthy jump. The markets basically reset to where they started to top out ahead of last week's price action. So we get this pop, but then we stall. And we stall perhaps waiting for NVIDIA's earnings, which have become a somewhat macro level risk. They've of course come out already and narrowly beat expectations. Or maybe it's just that the markets don't have conviction beyond headline risk. And perhaps then that lack of conviction is what we have on display here. Because if, in fact, the markets thought that everything was going to be just fine and the tariff threat had diminished, and we, of course, had reports of the emergence of this so-called taco trade, which, while the former Tina trade, there is no alternative, was a reason to buy U.S. tech stocks because there is no alternative, then the taco trade, which, funny enough, the president was pointedly asked about today, that stands for this sort of sense that the president always walks back the tariffs. Trump always chickens out is the acronym there. Now, we're certainly not suggesting that a 10% tariff, whereas it was a 2% tariff on average before, is anything like chickening out. That's not our perspective here on macro money. But there is this sense that that's what's going on, that's emerging in the markets, at least if you believe the chatter in the headlines. But, of course, if that's the case, then why did stocks not keep going higher? If, in fact, there is no issue here, and the Fed is wrong to be so circumspect and wrong to be so concerned, then why in the world won't we have the ingredients for a larger rally if, in fact, the all clear has been sounded? And it would seem that, at least at this point, we don't have those kinds of ingredients. And perhaps the reason that we don't is the markets themselves are not much less confused than Federal Reserve officials. And you get this sense when you look at the market's baseline expectations for economic activity. The Atlanta Fed puts together this model for GDP expectations. It's a nowcast. It takes in incoming economic information, and with an update every several days, sometimes even back-to-back days, gives you a sort of running tally on the tone of economic data going into a GDP release and what it might mean. And we're so far removed from second quarter GDP numbers that the actual model is probably much too early to show us anything, and you can see it idling here. But the major takeaway really is this giant range for baseline market expectations against which the model is getting graded. We can see here that the range of baseline expectations for second quarter GDP is shockingly vast, from a decline of 1% to growth of 3%. So nobody really seems to know what's going on, and that seems to not just be central bank officials. That seems to cover the Wall Street consensus for where things are heading. So with that in mind, we have a little bit of economic data left here for the week to see if we can't get a little bit more of a bias. And it begins with the Fed's favored inflation gauge, the PCE index. You're expecting to see further disinflation here, down to 2.2% on the headline and 2.5% on the core. That core is, of course, something that the Fed watches very closely, not only because most inflation is buried in that part of the equation, as you can clearly see here, most of it is in core services, but also because the Fed doesn't very much have agency over global food and energy prices. So needless to say, it focuses on where it can actually do stuff. 2.2% on the headline would be a significant sort of downswing. It would be the lowest inflation overall in 7 months. 2.5 at the core would be even more impressive. That would be the lowest since March 2021. So it would be returning us basically back here somewhere. So meaningful progress expected. The monthly increases seen as 0.1% for both core and headline, which if you look at what this would imply for the kind of running tally of where inflation is trending, the Fed looks at 3-month and 6-month annualized monthly changes to kind of get a sense of the trend a little bit more dynamically than year-on-year data. And you can see here, for 2 months now, we've seen this sort of cooling, and if we get the data coming out about as expected, then we'd be looking for a third. What's especially interesting here is the parallel to last year. We'll recall that last year the Fed also was resistant to cut rates toward the end of the first and going into the second quarter, even as the market was screaming that it's time to go. And you could see that with these increases here and the run-up in the higher frequency annualized measures here. So we can see here the 3-month annualized rate ticking higher, the 6-month annualized rate ticking higher. And we can see that on the way back down, it takes the Fed from a peak in March in these inflation numbers all the way out to September here before it actually feels comfortable cutting rates. And if we hear then what the minutes say and we see these dynamics, then perhaps we're looking at something similar where things are starting to go the Fed's way, but given their reaction function and how much slower they move relative to markets, we could be looking at another prolonged period where the Fed resists while the market wants rate cuts. Aside from this, we're looking at a range of revisions, the most notable ones. The second look at U.S. GDP is coming up. It's expected to confirm that we got a 0.3% contraction in the first quarter. And, of course, the markets are going to be looking at these internals here and seeing if anything about the skew from surging imports and the stuffing of those imports into inventories, and then the driving of a jump in investment on that basis. If that continues to be reinforced, it seems likely. But the real story here is about growth in consumption. Because once you take all of this tariff front-running anomaly out of the equation, it's this part that matters. And it matters most, as we've argued here extensively, because consumption is nearly 69% of overall GDP. Whereas everything else is more like an afterthought. And in fact, when you net out exports from imports, they come out to less than 5% of the whole thing. So, and netting them out is how you do GDP math. This isn't just doing random things to make the numbers feel small. So, when you look at that and you notice that in the first quarter you had the weakest consumption growth in almost 2 years, going back to the second quarter of 2023, the numbers take on a very different tone. Yes, there's a bunch here back and forth on tariffs and the front running of them, but that's not really the main story. It is, what will U.S. consumers do? And will they actually buy all of this stuff that has now been stuffed into inventory, and at what pace will they buy it? Because if they buy it slowly, if they don't rush, well, then inventories are going to stay full longer, businesses will have less impetus to buy more, and of course then economic activity slows. So the second revision for us to keep in mind is to the University of Michigan measure of consumer confidence to see what, in fact, consumers are going to do, because April's retail sales numbers looked soggy, and the consumer confidence numbers for May looked like they were some of the worst readings since the lows from COVID, where inflation was peaking at the expectations, and of course that led to a dramatic decline in sentiment, and as inflation expectations started to cool, so too sentiment started to improve until this tariffs episode right here. We can see inflation expectations have surged, sentiment has fallen off a cliff. The expectation is we'll get confirmation of these same numbers. This survey, interestingly, runs only through May the 13th, so only a day after the deal with China to postpone tariffs. Yesterday, we saw the rival consumer confidence gauge from the conference board, and it runs through the 19th, so there's a little bit more time there to digest the pause on trade barriers with China, at least those at full embargo levels of 145%. Now we're looking more at like 30 until yet another cliffhanger in August, when maybe the reprieve expires. And here there was an improvement in consumer confidence, albeit from a very low level to a less low level, but still an improvement. And it was across both the measures of the current situation as well as of expectations, and encouragingly the expectations improved more. So maybe we'll get an upside revision on consumer confidence. We'll see if that holds. What's interesting when we put all of this together is that the markets appear to be choosing a kind of bottom line through all of this uncertainty. Because when we look at what all of this has done to Fed policy expectations, we can see a very similar story to what was happening at about this time last year. Expectations for policy this year are getting anchored. But because the markets think that we need more easing, expectations for next year are getting more dovish. And so as the Fed resists action, as the markets appear uncertain of what to do next, we get just 41 basis points in rate cuts on the menu for this year. That's lighter than the Fed's own forecast of 50 basis points. But that is translating into a more dovish outlook for next year, where we now have 59 basis points. So we're still looking at 100 basis points in cuts this year and next, as the Fed envisioned. Current rates, we can see here, are at about 4.4%. That's the middle of the target range from 4.5 to 4.25. And the Fed anticipated that through 2026 will come down 1%, from 4.4 to 3.4. We're still seeing that, but the markets think that the Fed's resistance now will mean more cuts later. And if all this economic data comes in generally close to expectations, well, then more of the same seems likely to continue, because what the markets appear to have decided is that easing is coming. It's just coming later, and there will perhaps need to be more of it, while the stock market seems to have somewhat of a different perspective. Notice here the evolution in the benchmark S&P 500 here as a kind of catch-all for quote-unquote stocks, or general kind of risk sentiment in the markets. And the bond market's inflation expectations, these break-even rates that you get when you take the difference between nominal and real bond yields to get at the inflation adjustment that gets you from nominal to real. And so you see here that right around sort of mid-February or so, you start to see them decline in tandem. And of course, once you get into April and into Liberation Day, there's a level of hysteria for both inflation expectations and for the stock market. And all of this largely follows a growth scare. So in the second half of February, you start getting business confidence data, consumer confidence data that's telling you that the tariffs roll out. Not so much the idea that there will be tariffs, because if that were a concern, then the markets would already be freaking out no later than November, once the election was done, considering the president talked up tariffs all through the campaign. No, it was more the rollout. And once business and consumer confidence started to retrench, that's where you started to see the markets go, uh-oh, this is a growth scare. And so, not surprisingly, stocks and inflation expectations go down in tandem, because weaker growth is disinflationary. And so markets start to mark down inflation expectations. What's interesting is what we've seen since. In early April, we can see there's a bottom in both, but stocks clearly have returned to levels where inflation expectations have not. Stocks are almost 70% back from this decline. And we can see here inflation expectations are still somewhat downbeat and pointing to the threat downwind being of weaker inflation and perhaps therefore weaker growth. So the markets are over here seemingly saying there will be a growth downturn, or at least the risk is that inflation will surprise lower versus where expectations were at the start of the year. And that's largely because whatever economic downturn happens will overpower whatever upside risk to prices from the tariffs that the Fed seems to be afraid of. And so the market thinks the case for cuts is there. It just doesn't think they're coming, because the Fed clearly isn't of the same mind. So we see here, we have basically no changes in rates until we get somewhere over here. So perhaps we get a cut in September. Maybe we have to wait until November. But if we take a look at what the cumulative expectations look like for the September meeting, it's about a 60-40 split in favor of a cut, but the probability of standstill is uncomfortably high at 40+%, almost 41. And so you get the sense that you have now the market's convinced that it's time to cut, but also convinced that the Fed won't do it, at least for a while, that it's going to let the economy get hurt, that it's going to let some kind of a recession, or at least the precursors to it, take hold, where it can conclusively feel good about inflation expectations being anchored before it acts. And what all of this boils down to, perhaps, much as it did in mid-July through August of last year, once this similar sort of narrative took hold for markets. You can see that right here. There is then an adjustment. And the markets say, well, growth is going to be weaker, earnings are going to be weaker, rate cuts will come later, and the upshot becomes weaker stocks, higher bonds. And against that backdrop of future rate cuts that aren't coming soon, against the backdrop of that kind of a speculation, a weaker dollar and stronger gold. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Back with Chris for Futures Power Hour Mondays and Fridays. On with Victor Jones for the Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.